Hello, everyone, and welcome to the Suzanne and Sarah YouTube channel. I'm Suzanne Moore, a realtor here in beautiful sunny Bend, Oregon with Realty One Group Discovery and the founder of the Central Oregon Investor Network, which brings together investors not only from Central Oregon, but from all over the country to share resources, to learn from one another, and to create more passive income in our lives through real estate investments. So today we are going to talk to you about all the different kinds of loans you can use to buy a house. Some of these are more investor focused, some are more first-time homebuyer or residential focused, but we'll go through the full list of loans here at a very high level, and then you can expect us to do some separate videos on each different type. So if you're really diving into a certain type of loan, you'll get all the details you need here from Suzanne and Sarah. Hello everyone, welcome to the Suzanne and Sarah YouTube channel. I'm Suzanne Moore.
And I'm Sarah Willis. We are Central Oregon's investment and real estate experts.
So diving right in, we know that buying a home is a big financial milestone, probably the biggest financial decision you'll make in your life, and choosing the right mortgage loan is a really important part of the process. And there is a ton of variety out there for different kinds of mortgage loan products, and it can be totally overwhelming, but for you to understand the differences between them will also help you make the most informed decision that aligns with your financial goals and your financial circumstances. So in today's comprehensive guide, we'll explore the most common types of mortgages for buying a house, some of the different features of these different loans, and then when they might be the right choice for you. The first one that we commonly think of is a conventional loan, and this is what you think of when you call up a lender or a mortgage broker to get a loan on a house that you want to purchase to live in. Most of these loans are not necessarily backed by the government, but they might be a Fannie or a Freddie product, and they're offered by private lenders. So these loans typically require a higher credit score and a larger down payment compared to government-backed loans, which would be like VA or FHA. So conventional loans can either be fixed rate or adjustable rate mortgages, also known as ARMs. So when you might want to consider a conventional loan, it's a good choice if you have really strong credit history, stable income, you can afford a 20% down payment, which will help you avoid the private mortgage insurance, also known as PMI. Now getting into some of the government-backed loans, FHA is one of those. The Fair Housing Administration loans are government-backed mortgages designed to make homeownership more accessible for people, especially for first-time home buyers. They require lower down payments and have more lenient credit score requirements. So if you have a limited down payment or a lower credit score and you are a first-time home buyer or you haven't bought a house in a long time, you may qualify for FHA, and this could be a really great option for you. The next government-backed loan is a VA loan, or a Veterans Administration loan, and these are available exclusively to veterans and active duty service members, as well as certain members of the National Guard and the Reserves. So they are backed by the U.S. Department of Veterans Affairs and typically require no down payment. And they also have less stringent underwriting requirements. So if you are a qualifying veteran or service member, VA loans offer favorable terms and often don't require that down payment. And also they are assumable. So if you are looking at a house that has a VA loan on it that's assumable, you might be able to get an interest rate that is lower than what you might get in the current market. So that's another great benefit of VA loans. Another government-backed loan is called a USDA loan. So these are backed by the U.S. Department of Agriculture and really designed to help individuals purchase property in rural areas and become homeowners. So they offer low to no down payment options and competitive interest rates. So when might you want to consider a USDA loan? Well, if you're looking to buy a home in a designated rural or suburban area and you meet the income requirements, USDA loan might be very cost effective for you. The next one is fixed rate mortgages. So fixed rate mortgages have that consistent interest rate for the entire term of the loan. So typically loans are 30 years, but we can also get them in 20 and 15 years. Just depends on how low or high you want your payment to be. So monthly payments are consistent year over year, making it easier to budget. So it's a good option for you if you prefer stability and predictability in your housing costs monthly. The next one is an adjustable rate mortgage. So as the name implies, this means that the initial fixed interest rate is set for a certain period, like they call them like 3 or 5 year arms. So for 3 or 5 years, the interest rate will be fixed. And then after that time, it can adjust periodically based on market interest rate conditions. So monthly payments can fluctuate, potentially increasing over time. So ARMs can be really beneficial if you plan to move or refinance within the initial fixed rate period, because they often have lower initial interest rates as an enticement to get you to use an ARM. One thing we hear a lot about these days is jumbo loans, and the amount that a jumbo loan is really depends on the different location and the median home price. So here in Bend, the jumbo loan limit has been increasing every single year because the cost of homes has been increasing as well. So these are used for really high priced homes that exceed conventional loan limits. So right now, that number in the Central Oregon area is right around, I think, $762,000. So they typically have stricter credit requirements, and they may require a larger down payment. So if you are buying a high-end or luxury home, a jumbo loan is probably going to be necessary to finance your purchase unless you have a lot of cash for that down payment. Another option is interest-only loans. These allow you to make lower monthly payments by paying only the interest for a specified period. After that, you'll start paying down the principal and the interest. So why would you want an interest-only loan? It's really suitable for homeowners who expect their income to increase significantly over time, or those who plan to sell or refinance the property before the interest-only period ends. So many times hard money loans and private money loans are interest-only, and you never pay principal until you pay off the whole thing. The next one is balloon loans. So balloon loans have low monthly payments for a fixed period, often 5 to 7 years. And at the end of that period, the remaining loan balance is due in a lump sum, which is the balloon. And that may require either refinancing the property at that point or selling the property in order to pay off that balloon amount. So balloon loans can be a great temporary solution for borrowers who plan to move or refinance before the balloon payment becomes due. This is really common with seller financing, where you might have a loan for a certain amount to the seller. So let's say it's $500,000 and it's a 5-year note, but it's amortized over 30 years. So your payments are small enough as if it was a 30-year loan, but at the end of 5 years, you have to come up with the entire remaining balance or refinance or sell the property in order to pay off that balloon amount. The last one to think about is a home equity loan or a home equity line of credit, also known as a HELOC. And these loans really help you to tap into your home's existing equity. And a home equity loan provides a lump sum, while a HELOC acts more like a credit card or a line of credit that you can access at various times. So it's open for you and you don't pay anything on it until you start borrowing money from that HELOC. So home equity loans and HELOCs are really useful for funding home improvements, consolidating debt, covering major expenses, or investing in another property using your current home's equity as you pull it out through a HELOC and you use that money as a down payment on your investment property. That is it for today. And just to wrap it up, really, it's so important to choose the right mortgage loan for your situation, for your goals, for your finances. And it really should align with your future plans and financial goals. It's really important to explore all the different options and work really closely with a mortgage professional like a mortgage broker who has access to tons of different products so that you can be as informed as possible and make the best decision for your home ownership goals. So thank you so much for joining us today as we talked about all the different types of loans for buying a house. And before this video ends, please click the like and subscribe button, and we will see you on the next one.